Debt is often viewed as something to avoid, a burden that can heavily weigh on individuals and businesses. However, when used strategically, debt can be a powerful tool for wealth creation. Financially savvy individuals and companies have mastered leveraging debt to generate profits, build assets, and accumulate wealth over time. This video explores various methods for making money with debt, including the distinction between good and bad debt, strategies for leveraging debt, and essential considerations for responsible borrowing. Understanding good debt versus bad debt. Before examining ways to make money with debt, it's crucial to understand the difference between good debt and bad debt. Not all debt is created equal. Bad debt generally refers to borrowing that leads to diminishing assets or unnecessary consumption, such as credit card debt incurred from frivolous purchases. This type of debt provides no future value and drains finances through high interest payments. In contrast, good debt is used to acquire assets that appreciate over time or generate income. For example, taking out a mortgage on a rental property, financing a business, or investing in education can yield returns that far exceed borrowing costs. When leveraged wisely, good debt can catalyze wealth creation. Real estate investment utilizing mortgage debt. Real estate investment is one of the most popular methods of generating income through debt. Mortgages enable investors to purchase properties without paying the full price up front. By making a down payment representing a fraction of the property's value, investors can borrow the remaining amount and acquire an asset that will likely appreciate over time. Additionally, rental properties can provide a steady income stream, which can be used to pay off the mortgage while still generating a profit. For instance, if you take out a mortgage to buy a property valued at $300,000 and rent it out, the rental income can cover your monthly mortgage payments, maintenance costs, and property taxes. You build equity as property values increase over time and the mortgage balance decreases. Eventually, the property's market value may surpass the original purchase price, resulting in wealth accumulation. Some key considerations to keep in mind are 1. Interest rates. Securing a mortgage with a low interest rate can enhance profitability. The second is cash flow. Ensure rental income covers all expenses, including mortgage payments. The third is property appreciation. Although real estate usually appreciates, market conditions can fluctuate. Long-term investments tend to be more stable. Using debt to start or grow a business. Many successful entrepreneurs have utilized debt to finance their business ventures. Loans enable business owners to invest in inventory, marketing, equipment, and other essential resources needed for growth without depleting their personal savings. If the business generates sufficient profit to cover loan repayments and interest, debt can be a valuable tool for scaling operations. For example, a restaurant owner might take out a loan to expand into a second location. If the new location generates enough profit, the business's overall revenue increases significantly, far exceeding the costs of loan repayment. Business debt is often considered good debt, especially when it facilitates growth and enhances the company's valuation. Some key considerations to keep in mind are interest and repayment terms. Business loans typically come with specific terms that must be managed carefully. Risk of default. If the business fails to generate the expected returns, debt can become a liability. Growth potential. Only take on debt if it will help the business reach new levels of profitability. Stock market leverage, using margin loans. Margin loans allow investors to borrow money to invest in the stock market. By using margin, investors can purchase more shares than they could with their own capital alone, which has the potential to amplify their returns if the stock appreciates. When stocks increase in value, the investor profits not only from their initial investment, but also from the borrowed funds. For instance, if an investor has $10,000 and borrows another $10,000 on margin to invest in stocks, they effectively double their purchasing power. If the stocks gain 10% in value, the profit would be $2,000 instead of just $1,000. However, margin investing carries significant risks. If the stock price drops, losses are also magnified, which could lead to a margin call, requiring the investor to repay part of the loan. Some key considerations to keep in mind are market volatility and stock values can fluctuate significantly, so margin investing should be cautiously approached. Margin calls. If stock values fall below a certain level, the lender may require immediate repayment. Interest rates. Margin loans come with interest rates that can reduce overall profits. Using debt for tax advantages. Debt can provide valuable tax benefits, making it an appealing option for building wealth. For example, mortgage interest and interest on business loans are often tax-deductible, which helps reduce taxable income. Many investors strategically use debt to take advantage of these deductions, particularly if they fall into a higher tax bracket. When used appropriately, these tax benefits can make borrowing more affordable, allowing individuals or businesses to reinvest the money saved from tax deductions into other profitable opportunities. However, this approach can be complex, so it's advisable to seek guidance from a tax professional to maximize all eligible deductions legally. Some key considerations to keep in mind are tax laws. Tax regulations can vary. Ensure that all deductions are claimed in compliance with the law. Loan types. Not all loans offer tax-deductible interest. For instance, personal loans typically do not. Professional advice. Consulting a tax advisor can help optimize the tax benefits associated with debt. Debt recycling, a strategy for homeowners. Debt recycling is a financial strategy often used by homeowners to convert their home loan, which is considered non-deductible debt, into an investment loan that qualifies as deductible debt. This approach makes the interest on the loan tax deductible, which can be particularly advantageous for high-income earners looking to invest. As you pay down your mortgage, you can borrow more against your home equity to invest in income-generating assets, such as stocks or rental properties. For instance, if you pay off $10,000 of your mortgage, you could take out an investment loan of $10,000 using the equity you have built up. This borrowed money can then be invested in assets that are expected to generate returns. Over time, the value of these investments may increase, helping to build additional wealth. Some key considerations to keep in mind are risk management. Debt recycling involves ongoing borrowing, so it is crucial to manage your cash flow effectively. Investment selection. Not all investments yield positive returns. It's important to choose assets with strong growth potential. Financial discipline. This strategy requires discipline to ensure that recycled debt is not used for consumption, but rather for investment purposes. Leveraging debt in peer-to-peer lending. An innovative way to earn money through debt is by participating in peer-to-peer lending platforms. In this scenario, you act as a lender, providing loans to individuals or small businesses who repay you with interest. While this approach does not require you to take on personal debt, it does involve lending your capital with the goal of generating returns through interest payments. Many investors utilize peer-to-peer lending to diversify their portfolios and earn passive income. However, a significant risk is that borrowers may default on their loans, making it crucial to research and choose reputable P2P platforms that effectively assess creditworthiness. Some key considerations to keep in mind are risk of default. Borrowers might fail to repay their loans, leading to potential losses for lenders. Interest rates. Higher interest rates are often associated with higher risks. Platform reputation. It's essential to select a reliable P2P platform with a proven track record. The risks and rewards of using debt to build wealth. Although debt can be a powerful tool for building wealth, it carries inherent risk. Mismanaging debt can lead to financial strain, reduce creditworthiness, and, in extreme cases, bankruptcy. To use debt effectively, it's essential to have a solid repayment plan, understand interest rates, and choose investments carefully. In conclusion, using debt to generate income is not suitable for everyone, but for those willing to take calculated risks, it offers a variety of opportunities. By understanding the difference between good and bad debt, selecting profitable investments, and managing debt responsibly, individuals and businesses can leverage debt to create wealth. Whether through real estate investments, business expansion, stock market leverage, or tax advantages, debt, when used wisely, can be a powerful tool on the journey to financial independence and wealth creation. Subscribe for more videos. Thank you.